Hi, this is Matthew Cratter from Trader University, and today I want to talk about Bitcoin, why it's up so much in 2020, and why I think it's headed much higher over the next 6 to 18 months. If you're interested in Bitcoin, crypto, or just want to see what I'm trading, what I'm investing in, what I think is really going to outperform, be sure to hit that subscribe button. So the days of Bitcoin at 7,000 per coin are long gone. It's been I believe it's the best performing asset of the year for a broad asset. The Dow this year is down 16%. That's the Dow Jones Industrials. The S&P 500 is down about 11%. The NASDAQ, which has been holding up the best, it's got all the monopolistic big tech companies, all the FANG stocks, just down about 1.5% as I'm recording this before the market opens. Now, the big performer among traditional asset classes has been gold, up 11%. Now, this is very exciting for gold bugs. 11% is not that exciting for me, but gold is still a very good store of value and has been outperforming stocks. It's been outperforming everything else. But what's unbelievable, a lot of people haven't really been paying attention to the percentages. Bitcoin is up 29.98% in 2020, up almost 30%. So outperforming the Dow by about 46 percentage points. Now, why is it doing that? What is the backdrop? Well, the backdrop is the financial crisis and what the Fed, the central bank, and Central Bank of the U.S., the Federal Reserve, and global central banks have to do in the wake of this coronavirus crisis and financial crisis. They have to print a lot of money to shore up demand. And so here's a great meme. They said it was forgery, so we renamed it Quantitative Easing. Now, what does quantitative easing look like? Basically, the Fed prints new money. They don't do it obviously manually. My daughter was concerned that printing all this new money they'd have to cut down a lot of trees, but it actually just requires electricity. They just press a button on their special computer. They create more U.S. dollars. This is the great thing about having the world reserve currency. You can just print money whenever you want to buy things, whereas other countries actually have to create stuff. So quantitative easing, the Fed prints new money, and then it buys treasuries, it buys mortgage-backed securities, it buys munis, it is even buying junk bonds. This is the Federal Reserve's balance sheet shooting off the charts, going from 4 trillion to above 6 trillion, and probably headed much higher simply because of the situation that we're in. Now we have prominent professors. Ken Rogoff is economics professor at Harvard, very well respected, listened to by hedge funds and central bankers. He's out with a new article talking about how we need deeply negative interest rates. Now, for those of you who don't understand how these work, imagine that you work really hard, you make some money, you pay taxes on it, and then you stick it in the bank for safekeeping. You're scared to put it in real estate now. You're scared to put it in the stock market, both very volatile. And so you put $100 in your savings account. If we move to this system that Ken Rogoff wants, there will actually be negative interest rates associated with holding your money in the bank. So even after working hard, paying taxes, you deposit $100 at a negative 5% interest rate. At the end of 1 year after holding your money in your wonderful U.S. bank, you will have $95 left. And you can see how very quickly this would drive your savings down very close to zero. And what this means is that people will be forced into stocks. They'll be forced into riskier assets, which may or may not perform well. But this is really the end of the fiat system when you have interest rates not just at zero, but going negative. This is a very strange thing. And the public is not going to put up with this. This is outrageous. It's a inflation tax. You have an inflation tax, you have regular taxes, and then adding interest rates, negative interest rates to that is really an abomination. So that's where we're headed, almost certainly in the U.S. This is already happening in various European countries. Now, what about Bitcoin? Why is Bitcoin performing in this environment? Well, for one thing, if you can just stick your money in the bank like you used to be able to in the early 2000s and earn 5 or 6% in T-bills or high yield savings account, why not do that all day? But when interest rates go to zero or negative, zero yield bearing assets. So for example, gold doesn't pay you any interest and Bitcoin doesn't pay you any interest, these become more attractive because they're not competing with T-bills or treasuries or savings accounts that pay you decent interest income. So that's why zero yield assets become much more attractive in a low interest rate environment. Now, what's happening with Bitcoin? That's sort of the macro backdrop. Money printing, quantitative easing, negative interest rates. And what's happening with Bitcoin? Well, Bitcoin is approaching what's called the halving or the halvening, and this is when the money that's paid to miners who keep the network secure, what's called the block subsidy, when this gets cut in half. So currently, if you're a miner and you come up with the first, you mine the first block, or you compete in the race to create a block, and you're the first one there, you get a block subsidy of 12.5 Bitcoin. At current prices, this is about $115,000. So what you do is you buy one of these mining machines, you use some electricity, you mine some Bitcoin, and then you sell the Bitcoin to pay your electricity bill. Now, the current subsidy is 12.5 Bitcoin. On May 11th, late on May 11th, early May 12th, it looks like this is going to be cut in half to 6.25. This is just this is built into the Bitcoin software. This is called the halving. So the reward at current prices will go from about $115,000 to about $57,000. Now, at the same time, we see a lot of new computing power moving on to the network. If we look at the hash rate, this is the total hash rate of the Bitcoin network. It's just a measurement of computer power. And we can see that since April 6th, it's moved from about 104 million up to close to 119 million. So what this basically is, more computing power being added to the network. Now, this is very strange because we know that in just a few days, in less than a week, the reward for miners who are on this network is going to be cut in half. So why are people moving more computing power onto the network? And I'll show you exactly what that means. Here's what an old miner would look like, and this is a S9 miner. These are basically just computers that do very high speed, very data intensive, very computing intensive calculations. So this is the old S9 miner. You can see that you can buy them now for about $50 or $60. They really don't have any value left. The new miners, the new S17s, are much more expensive. This one is $2,700. So what's happening, and what will happen after this miner reward, this block subsidy gets cut in half, is that these machines, these old machines, will no longer be able to make money because they don't have the computing power available. They're inefficient, they're high cost, and so their margins are going to go to zero or go negative once this block subsidy moves from 12.5 Bitcoin to 6.25 Bitcoin. But what's going to happen to these new miners? They're going to have very high margins, even with the mining reward being cut in half. And because they have high margins, they will not need to sell as many Bitcoin into the network. So what happens, you mine some Bitcoin, you get paid, you sell the Bitcoin to pay your electricity costs and to take profits. But if you have a really high margin machine, you are able to continue to mine Bitcoin, and you're able to hold on to more of it. You don't need to sell quite as much to cover your mining costs. And so as a result, the mining pressure on the network will go down. The supply pressure will go down. It's similar, Anthony Pompliano has the analogy, it's like closing half the gold mines in the world. Supply production is going to be cut in half. So instead of producing 1,800 new Bitcoins every day, that's about what are mined, we're only going to be getting 900 Bitcoins per day. 900 new Bitcoins per day. And fewer of these will need to be sold because we're going to have these very powerful mining rigs online. Now, this is against the backdrop of quantitative easing, printing more money, huge demand for zero yield assets. So this is the first thing that happens. The new floor in Bitcoin moves up simply because there's less mining pressure. And so that's sort of the mining side of things. And then we enter the point at which speculators take over and momentum takes over. FOMO, fear of missing out. And this will happen at higher prices. If we look at a monthly chart of Bitcoin versus the dollar, we can see that there's big, the last real high was about 14,000, barely got it, didn't really quite get to 14,000. And then the high from the end of 2017, the all-time high is about 20,000. So once we trade above 14,000, and again, there's going to be natural upward pressure on Bitcoin simply if you assume demand stays the same or increases and supply gets cut in half at the halving. And again, the more this guy prints money, the more demand, the more the US dollar will be devalued, and the more Bitcoin and gold will go up. So you reach a certain point where the mining becomes less important and the speculators take over and momentum takes over. And that's what's really going to take it once we get above 14,000, 16,000, 20,000. And you can see that we never really spent that much time above 14,000. There was a couple brief spikes above it. But really, we're very, very close. Obviously, 10,000 is a key level. But as Bitcoin continues to outperform, any asset that's up 30% in a year when everything else is down is going to start to get institutional investors' attention, retail investors' attention. I'm a long-term Bitcoin holder. I'm not going to be selling. I'm not really a speculator. I'm holding out for much, much higher prices. But there are a lot of people who just will trade momentum. And there's certainly nothing wrong with that. I trade a lot of momentum stocks when they're available. But we're going to reach the point where we're going to have a phase transition from this sort of floor being put in by the miners to a speculator's market, a momentum market. Now, this is going to be driven. Actually, I should point this out. This is a nice diagram that Preston Pysh did that talks about some of these same dynamics. The movement from inefficient miners to efficient miners, and the takeover in momentum. Now, there's this stock to flow model that I'm always talking about that Plan B came out with, and there are various versions of it. Here's Dan Morehead at Pantera Capital, a very good hedge fund, talking about how he expects Bitcoin to hit 115,000 by August of 2021. Plan B himself is out with a new model that projects prices for Bitcoin of 288,000 roughly between 2020 and 2024. I'll link to this paper. What all of Plan B's papers look at is they look at the relative scarcity of Bitcoin. They look at the new Bitcoin that's being produced, which is the flow, versus the current inventories, which are all the Bitcoin that have ever been mined. And so he's got various models. His first model comes up with a price of something like $50,000 to $100,000 for the price of Bitcoin after this May 11th mining. And then his latest paper has a higher target. I think if this cycle is fairly weak, things don't work out very well, I would suspect that we still get to something like 30K or 40K on Bitcoin. Now you have to remember Bitcoin's currently just at about 9,000. So these are just tremendous returns. This is 3x, 4x on your money. So that's the miners and the momentum. Now here's a chart using Plan B's original model, and you can see that what happens is that during this momentum phase, you will get very far above the stock to flow level, as predicted by the model. So this purple line, I know it's a little bit hard to see, but I'll stick a link in the description notes below. This purple line shows the average over 10 days, the stock to flow. And you can see that in late 2017, we had the stock to flow was something like 6,000 according to the model. We shot way above it. We shot up to 20,000. This says 13,000 end of day. But basically, what you can see the overshoot of the purple line. This is what happens. Something similar happened after the 2012 halving. We had a huge run up, and in the year and a half following, we overshot the model. And that's really the phase where momentum takes over. So where are we now? Today we are right about, call it right here. We have stock to flow at about 8,300. We have the price of Bitcoin at about 9,300. And you can see how after the halving, the stock to flow for Bitcoin moves moves up to 88,000, 90,000, and will stay there. According to this model, the other Plan B model is a little bit higher, but we're talking 90, 97,000, somewhere around that. Call it 100,000 for 2020 to 2024, and then we have the 2024 halving, and we jump up again, and we reach about a million. Call it 1.1, 1.2 million on the model. Now, as we saw before, you can get huge overshoots where the stock to flow is at about 6,000, and it goes actually, the price of Bitcoin goes to 20,000 because speculators draw it. So what we're looking at here is a target of somewhere around 90 or 100,000 with a possibility of a huge overshoot. If you're using Plan B's other model, the 288,000, these numbers would obviously be much higher. So 288,000 would be the model price. And then if you got an overshoot, you could get to 300,000, 400,000, even 500,000. And I think we have a much higher probability of doing that simply because of the current macro backdrop. And so I think it's going to be a very, very interesting market. It's not one that you're going to want to time the top on. That's why I'm a long-term holder of this. I'm not going to be selling until we get somewhere above $1 million. Now, what happens if this model is validated at in the May 2020 halving? Institutional investors will begin to see how accurate this model is, and they will begin to price in future halvings. So something similar happens to stocks. If people realize that Apple is going to have a really good earnings report, or its earnings are going to move sort of to a new higher level over the next year, this will become priced in as the information sort of leaks out, inside information, but also just public information and public monitoring, for example, of Apple stores and how much they're selling, etc., activity in the App Store, etc., and it will start to get priced into the stock. And this is how financial markets work. They're always trying to price in future data. So, for example, we've had this bounce in the stock market perhaps pricing in the lifting up of the shutdown and people going back to work, etc., etc. But this is how financial markets work. This is how institutional investors work. They're always skating to where the puck is. So what could happen is, if this model is proven correct, and we fairly quickly, by the end of the year, or certainly by the summer of 2021, if we're above 100,000, what could very well happen is institutional investors, high net worth individuals, hedge funds, and even some bigger players, which we're going to talk about, could begin to front run the 2024 halving and begin to price it in. If we think this model is going to hold, if we think Bitcoin has a probability of, let's say we think it has a 10% probability of trading at $1 million in the coming years. Well, 10%, and then let's say we think it has a 90% chance of going to zero. If you just look at the expected return from that, or the expected value, you would take 10% of $1 million, which is 100,000, plus zero, 90% chance of it going to zero. Its expected value, using probability theory, using statistics, should be about 100,000. And so Bitcoin should fairly rapidly move to much higher number as investors price in the stock to flow model. Now, I wanted to show you a couple more interesting things before we leave. This is something a lot of people have been talking about, the HODL waves. HODLing just means buying and holding. It's a fairly Warren Buffett way of doing things. But this shows that Bitcoin and how long it has been since those Bitcoin moved. So this blue area at the top are Bitcoin that have been held in the same place for 5 years or more. They've basically been put into a hardware wallet. They haven't been transacted. They haven't been moved around. These are the hardcore Bitcoin hodlers. This is how I'm treating my Bitcoin. And we can see that over time, the blue has grown. The next one down is the 3 to 5 year holders. The next one down, the 2 to 3 year holders. And at the bottom, we have the speculators who are trading in and out, holding for less than a day. But what we can see, this downward slope, is that more and more people are taking Bitcoin. They're taking it off the exchange. They're putting it on a hardware wallet, and they're not trading it anymore. This is very similar to a stock that has a very small float. It may have a lot of shares outstanding, but if it has a small float, it's very easy for the stock to move up and very easy for the stock to move down. This in part explains a lot of Bitcoin's volatility. Obviously, it can move up a lot, it can move down a lot. But as this increases, as these HODL waves increase, what it means is that Bitcoin are being put away. It's a little bit like taking gold and sticking it in a vault for your great-great-grandchildren. It's not going to be it's not going to be a source of supply, driving the price down if you take it to a pawn shop or take it to a broker to sell. And so what this means, this is another way that the floor, sort of the natural price floor, rises in Bitcoin. Bitcoin becomes more and more scarce. There are only going to be 21 million Bitcoin, and a bunch of them have been lost, so the actual number is much lower than that. So combined with the mining dynamics, all the central bank money printing and inflationary monetary policy, we have these HODL waves where more and more smart people are waking up and realize they need to have some Bitcoin and they need to stick it in the proverbial vault. So this also helps to relieve selling pressure. And as people begin to realize how this works, it's going to be a source of future buying pressure. Now, how do we take Bitcoin to the next level? How does it get to, so after the next halving, it's going to have a stock to flow close to gold. Gold currently has about a 10, 11 trillion dollar market cap. Bitcoin's still at about, I want to say 150, 160 billion. So still a very tiny market. Where are the buyers going to come from? Yes, there'll be some retail investors, but the buyers that we really need to take this to the next level will be much bigger players, institutional players, pension funds, endowments, hedge funds. If there's a Bitcoin ETF, that would be a natural source of buying. We can see that institutional money has begun to move into the space. Coinbase has been reporting this, and there's lots of other evidence of it. So that's the next step. The institutional investors have huge amounts of money to deploy, and when they see an asset that's up 30% on the year when everything else is down, they're going to have to wake up and take notice. More and more people are waking up and taking notice. And when this happens at the institutional level, there's a certain point at which the dam breaks. Right now, if you buy Bitcoin and you're an institutional investor, there's some real career risk. If it goes down, if it goes down, you could be fired. If it goes up, they might just say you're lucky. But at a certain point, it becomes a necessary asset to hold. Right now, there are a lot of institutional flows into gold as people are waking up to that. And Bitcoin is becoming more and more adopted by institutional investors. So that would be the first stage, these really big investors that have billions or trillions of dollars to put into Bitcoin. Now, Bitcoin, when something just has a market cap of 150 billion and you start adding trillions of dollars to it, trillions of dollars of buyers, it can obviously move up 10x, 20x, 50x, 100x. And I think that's what we're seeing beginning to be priced into the stock to flow model. To take us to this next level, it's going to be institutional investors, and then the next step is really the nation state buyer. There's good evidence that Vladimir Putin understands how cryptocurrencies work. I wouldn't be surprised if he has a bunch of Bitcoin himself. I wouldn't be surprised if there are a lot of central bankers that have Bitcoin as well. But there's a certain game theory that goes on here, and I think this tweet from Phil Bonello really lays it out in good terms in terms of the prisoner's dilemma. So what we have here is basically we have Nation A, and Nation A has a decision: don't buy Bitcoin or buy Bitcoin. We have Nation B, don't buy Bitcoin and buy Bitcoin. And so the prisoner's dilemma is, how do you work with someone else and get the best outcome for yourself? But you always have to be, it's a little bit like chess. You have to be thinking many, many moves ahead. So if both of them don't buy, central banking is unaffected. But the problem is each nation is going to be worried that the other nation might buy. So if Nation A buys early and gets rich, then Nation B is in trouble. Nation B comes late to the game and is much poorer. Now, this would make a lot of sense for a small country to start accumulating Bitcoin. And there's good evidence that China and Russia have really been accumulating gold. They may be accumulating Bitcoin as well, or their central banks may be doing that. This would be a huge advantage for a small country. If you're a small country in Africa, if you're a small country in Asia, maybe a Singapore or something like that. If you get into Bitcoin early, the multiplier is so high that you can really leapfrog ahead of a bunch of nations. And so that's why there's this dilemma. And likewise, if nation B buys early and nation A is late to the game, then nation A falls behind. And so the natural place for both of them to be is just to buy a little bit of Bitcoin. That way, if you think something's going to go up 100 or 200 times, that's a pretty good risk reward. The worst that can happen to Bitcoin is it can go to zero. And so, a central bank of a small country buying 500 million or $1 billion or $2 billion worth of Bitcoin, which would obviously be huge, is a very good risk reward trade. And so it makes, from a game theoretical perspective, it makes a lot of sense for nation states to begin accumulating Bitcoin just to be safe. $1 billion or $2 billion here or there doesn't make a big deal. But if Bitcoin goes to $1 million or $2 million or $5 million or $10 million, you can really leapfrog the competitors. So I wouldn't be surprised if we're already seeing some central bank buying, probably very small, and not the major economies, not the U.S. central bank yet, or possibly the Chinese central bank, possibly the Bank of Japan. But there's a big incentive from a game theoretical perspective to be an early adopter in Bitcoin. This also works for individuals. If you buy Bitcoin and it goes to zero, well, maybe you've lost a little bit of money. You put 1% of your net worth. If it goes up a lot, you've done really, really well. If your neighbor buys it and you don't, all of a sudden your neighbor could be extremely rich, and you've fallen behind. So this is why I would encourage everyone to take a look at Bitcoin. Check out my other videos on it, which I'll link to below. And before you critique it, can it be banned by the government? Is it a tulip bubble? Is it a scam? Is it a Ponzi scheme? All these things. I'll stick some links to videos below where I discuss these most common objections. Please hit the subscribe and like button if you found this video helpful, and let me know your questions and comments in the comment section below. Thanks a lot for listening, and I'll see you in the next video.